Welcome to The Debate. Welcome to Breaking News to Trading Moves. Usually when we talk about a diagnosis, like say a medical diagnosis, there is this expectation of absolute precision. You break your arm, the x-ray shows that jagged white line, and the doctor points right at it.
Right. Yeah. It is completely binary. Broken or not broken. It is just a clean visual.
Yeah, exactly. But step into the modern retail day trading ecosystem, and that x-ray machine just, well, it shatters. We are looking at a financial landscape where the lines between opportunity and exploitation are incredibly blurry. Millions of retail participants are jumping into this arena globally right now. And the tension we are debating today really comes down to this. Is this day trading ecosystem an inherently predatory structure built entirely to separate everyday people from their money? Or is it a legitimate, highly competitive arena where a disciplined minority actually captures real, verifiable profit through skill?
And, to be clear on where we stand today, I maintain that while bad actors are undeniably out there, trading is a verifiable profession. There is a persistent minority of skilled individuals who overcome the structural costs of the market and capture true alpha, meaning they consistently generate returns above the market benchmark, mostly through execution advantages and solid strategy.
And my position is that the ecosystem operates as a predatory extraction engine. I mean, it relies entirely on exploiting human behavioral biases. Platforms, brokerages, and marketers secure guaranteed profits from the almost mathematical certainty that the retail trader will fail over time.
Well, let us look at the actual empirical data before we declare the entire system predatory. Look, the high failure rate among day traders, that is an undisputed reality. I am not going to sit here and deny that. But a high failure rate does not automatically equal a scam. When we actually look at comprehensive records, take the 5-year analysis of the Taiwan Stock Exchange, for example, it proves that a specific subset of traders, roughly about 1% of them, demonstrate this persistent, repeatable ability.
I mean, 1% is an incredibly small survival rate.
It is small, sure, but it is real. They earn what we call a 62 basis point spread per day. For the audience, a basis point is 1/100th of a percent. 62 of those earned consistently day after day, that comfortably covers transaction costs and yields well above average annual incomes. Furthermore, economic data confirms that 28% of financial influencers on social media are genuinely skilled, providing abnormal returns for those who follow them. The exchanges you mentioned, they are just the required infrastructure for this high-level competition.
Okay, so let's focus entirely on that infrastructure, because you claim it as just a neutral playing field. But the business of trading is entirely divorced from the success of the trader. Imagine a privately owned toll road.
Okay, I am picturing it.
So the company that owns the road makes money every time a car passes through. But this particular toll road has speed limits that change randomly every 5 seconds. And the retail drivers are essentially driving blindfolded. Meanwhile, high-frequency algorithmic trading firms literally own the traffic lights.
Well, that is quite the visual.
It is exactly how the market structure operates. Platforms like Binance or hardware providers like NVIDIA, they are the toll road owners. They earn a guaranteed existence tax. Every single time a trade is executed, a fraction of capital is extracted in fees, commissions, or the bid-ask spread, which is just the difference between what a buyer pays and a seller receives. The house always takes a cut. And because they always take a cut, the math dictates near certain ruin for the average participant. The system demands constant churn. It needs a continuous influx of new retail drivers on that road just to sustain its own revenue.
Look, providing infrastructure is a neutral act. It is not malicious. The presence of transaction costs does not negate the existence of alpha. You brought up the Taiwan analysis earlier. It is one of the most comprehensive data sets available globally, right? It tracks over 130,000 investors. Every single trade, every single execution. What that data actually shows is that the heaviest day traders, those transacting over 90 million new Taiwan dollars in a 6-month period.
Which is just an incredible amount of volume for a retail participant.
It is, yeah. But what the data reveals is that these high-volume traders actually earn gross profits.
Let's pause right there, because gross profits is a really critical term for our listeners.
You mean they are making money before they pay the tolls on that road?
Correct. Before the transaction taxes and exchange fees are deducted, their trades are inherently profitable. They possess a demonstrable edge in reading the market and executing at favorable prices. Yes, friction exists in the form of fees, but to suggest the providers of the market structure are maliciously extracting wealth entirely ignores that the market structure is exactly what allows that edge to be realized in the first place. I mean, you cannot have price discovery without an exchange.
Well, I'm not convinced by that line of reasoning, because if the vast majority of your customers are mathematically guaranteed to lose money net of fees, doesn't providing that infrastructure cross the line into active exploitation?
How does it cross the line? If a gym charges a membership fee and 80% of the members stop showing up after February, is the gym actively exploiting them by keeping the treadmills plugged in?
That is not a perfect comparison at all. With a gym, the failure is a lack of participation. In day trading, the failure is active participation. The more they use the treadmills, the more money they lose, because those heavy day traders you just mentioned, even with their supposed skill, they still lose money net of fees. The average account in that ultra-heavy day trader partition incurs daily net losses. The infrastructure tax eats the entirety of their purported skill. So the toll road operators are building wider roads to facilitate more volume, knowing full well the drivers will crash. They are actively facilitating wealth destruction.
Financial markets are an open ecosystem. Asset prices are driven by external economic realities, right? Corporate earnings reports, macroeconomic data, supply chain disruptions. The fact that most participants lack the discipline or skill to navigate that environment does not make the matching engine malicious. And let's be mathematically precise about the Taiwan data here. While the average heavy trader might barely break even or take a slight net loss, the top 1% of those traders, the absolute best of the best, are wildly profitable after all fees are paid. They are executing a skill, and the infrastructure allows them to monetize that skill.
But to find that 1%, the system requires an enormous constant supply of fresh capital to feed the machine. If 99% fail, the toll road runs out of cars. And that brings us directly to the marketing funnel. The ecosystem needs volume, and it gets that volume through outright deception.
Deception is a pretty strong word to apply to an entire global financial ecosystem.
Let's look at the mechanics of the marketing then. You have financial influencers basically selling courses and pumping stock alerts. Look at the Federal Trade Commission's action against warrior trading. They handed down $3 million in fines for making completely unsubstantiated earnings claims. The CEO claimed verified profits of over $100,000 in under 45 days, promising consumers they could learn 3 simple strategies to achieve financial freedom. How did that actually play out for the consumers?
Well, the vast majority of those customer accounts lost thousands of dollars. I am familiar with the case, and I agree it was egregious.
Thousands lost in the market, on top of the thousands they paid for the courses themselves. It is a double extraction.
Look, I will not defend fraudulent behavior. The FTC's action was entirely justified, and there are undeniably bad actors who sell false promises to vulnerable people. But you are conflating the marketing of fraudulent courses with the actual mechanics of the stock market. They're 2 different things. Furthermore, not all advice on these platforms is deceptive. The American Economic Association analyzed financial influencers on platforms like StockTwits, evaluating their actual verified performance rather than just their marketing claims. And they found that 28% of these influencers possess true skill.
28%.
Yes, 28%. And they provide solid empirical advice, leading to abnormal returns of up to 2.6% monthly for the followers who actually listen to them.
Okay, let's break down exactly how they get those returns, though. Like, what is their structural edge?
Would it operate as contrarians? When the social media crowd is euphoric and blindly buying, they are cautious. They also exploit what we call short sale constraints. For the audience, a short sale constraint occurs when it becomes difficult or excessively expensive to bet against a stock, usually because there just aren't enough shares available at the brokerage to borrow. When a stock is artificially pumped up by hype but cannot be easily shorted by institutional funds, these skilled influencers recognize the mispricing. They wait for the hype to collapse and capitalize on the inevitable drop. The expertise clearly exists, and it is publicly available for anyone willing to learn.
Okay, let's look closer at that very same American Economic Association data then. You highlight the 28% who have skill. But the researchers also found that 55% of those influencers are what they explicitly term anti-skilled. Following their advice results in a negative 2.3% monthly return. And we really need to explain how these anti-skilled influencers operate, because it is not just innocent bad advice. It is a mechanical, predictable trap.
A trap in what sense?
Biases and, their deepest hopes. If a retail trader desperately wants to believe a penny stock is going to rally so they can quit their job, they will find an influencer shouting exactly that. The anti-skilled influencer tweets excessively, they chase past returns, and they post overly optimistic messages right before massive price reversals.
Which is undeniably poor trading practice.
But it's worse than that. In many cases, the influencer is actively using their own followers as exit liquidity. The mechanism works like this. The influencer buys a cheap, low-volume stock. They use homophilia and aggressive optimism to whip their followers into a frenzy. The followers start buying, which organically pushes the price up because the stock has low trading volume. Once the price spikes, the influencer sells their own shares into that artificial demand. They lock in their profit, leaving the followers holding the bag when the buying pressure evaporates and the price inevitably crashes.
So you are describing a classic pump and dump scheme.
Exactly. And the critical piece here is the platform infrastructure itself. The social media algorithms reward engagement. Nothing drives engagement like reckless optimism, flashy promises, and the fear of missing out. The loudest, most dangerous voices are basically amplified by the code.
I see your point, but you are describing a failure in audience engagement metrics, not a structural flaw in trading itself. The retail public frequently chooses entertainment over accuracy. They prefer the loud, optimistic voice over the measured, contrarian voice. The skilled 28% are sitting right there. They offer data-driven advice. They avoid herding mentalities. If a retail trader decides to ignore the diligent mentor focused on risk management in favor of someone posting pictures of least exotic cars, well, that is a behavioral failing of the audience.
I see why you think that. But let me give you a different perspective. If the platform's algorithm and human psychology inherently reward the anti-skilled 55% with the most visibility, doesn't the ecosystem purposefully bury the skilled minority to maximize engagement and transaction volume?
Purposefully?
Yes, purposefully. The platforms know that fear and greed drive transaction volume. The anti-skilled influencers stimulate that greed. By allowing them to dominate the visibility algorithms, the ecosystem ensures a steady supply of uninformed capital flows into the market. That capital is then immediately extracted by the exchanges and brokerages via transaction fees. It is a symbiotic relationship. Bad advice generates volume, and volume generates tolls.
Using the word purposefully implies a grand conspiracy between social media algorithms and exchange matching engines, which simply isn't reality. Social media algorithms are engineered to maximize time on screen. That naturally favors sensationalism. Market matching engines are engineered to match buyers and sellers as efficiently as possible. The fact that these two distinct technologies overlap to the detriment of an undisciplined trader is an emergent property of the modern internet. It is not a deliberate extraction plot. Regulatory bodies actively suppress bad actors when they catch them.
But the regulators are constantly playing whack-a-mole. As soon as one operation is shut down, 3 more pop up. And what keeps the retail capital flowing, despite these massive failure rates, is the illusion of success. Survivorship bias entirely obscures the reality of day trading.
Well, survivorship bias is definitely a factor in how the public perceives trading, sure?
It is the defining factor. I mean, think about Abraham Wald and the World War II planes.
Oh, right, the armor plating study.
Exactly. The military wanted to put armor on the parts of the returning planes that had bullet holes. But Wald pointed out that we only see the returning aircraft, the ones that got hit in the engines. Well, they went down. We never see them.
Yeah, you only see the survivors.
Right. In trading, we only see the surviving mutual funds or the loud influencers bragging on social media about a winning trade. We completely ignore the planes that went down, and there are a lot of them. Like nearly 40% of day traders quit within one single month. 80% are totally wiped out and gone within 2 years.
And I agree that survivorship bias heavily colors public perception. It is very easy to assume success is common when failures disappear quietly. But in rigorous empirical analysis, we explicitly account for survivorship bias
How exactly?
by tracking the entire cohort from day one. The Taiwan study did not just look at the survivors at year 5. It tracked every single account, including the ones that blew up in the first month. And what did the data find among the individuals who stayed profitable? It found persistence in ability.
Meaning they didn't just get lucky once?
Exactly. Traders with historically profitable performance continued to earn strong returns over the subsequent 6 months. This was not a random distribution of luck. Look, if you flip a coin enough times, someone will inevitably get 10 heads in a row, but that person won't reliably get 10 heads in a row the next time you test them. These top traders demonstrated a structural, repeatable skill over long horizons.
Okay, so we need to define what that skill actually is, because, if they are just reacting a microsecond faster than a retail investor trading on a smartphone, that is not a sustainable economic contribution. That is just latency arbitrage.
Okay, let's explain latency arbitrage for the audience so we are on the same page.
Right. So latency arbitrage is when a trader, usually using incredibly fast algorithms and specialized fiber optic cables, sees an order hit the market and races ahead to buy the asset first. Then they just sell it back to the original buyer a millisecond later at a slightly higher price. They are essentially front-running slower participants purely based on speed.
Right, and I am glad you defined that because the persistent skill we see in the top retail traders is much more sophisticated than latency arbitrage. I mean, retail traders do not have the fiber optic infrastructure to compete on speed alone.
Okay, so how are they making these consistent returns then?
Well, the data shows that nearly 3/4 of the trades executed by these persistently successful individuals rely on aggressive limit orders.
Okay, walk us through what an aggressive limit order does mechanically.
So a standard market order just says buy the stock right now at whatever price the seller is demanding. It guarantees you get the stock, but you might pay a terrible price. A limit order says, I only want to buy the stock if the price drops to $10. It controls the price, but you might never get the stock if it doesn't drop. Now, an aggressive limit order is when a trader places a cap on the price, but they set that cap at or slightly above the current asking price.
So they are crossing the spread to take the liquidity immediately, but still capping their worst-case scenario.
Precisely. They are forecasting short-term price trends and actively placing orders that execute against available liquidity. They are reading the order flow, interpreting macroeconomic information, recognizing when an asset is mispriced, and acting decisively before the broader market corrects the error. It requires a profound understanding of market mechanics, strict risk parameters, and the discipline to execute without emotion.
Even if I grant that a tiny fraction, literally 1%, possesses this highly specific ability to read order flow and forecast short-term movements, the reality is that their profits are directly funded by the losses of the uninformed majority. The ecosystem requires the 80% to fail so the 1% can extract their alpha, all while the exchanges take their cut from both sides of the trade.
You are describing competition.
I'm describing a negative-sum game. Once you subtract the transaction cost, the participants as a whole are mathematically losing money. The entire educational marketing complex is designed to funnel fresh liquidity into that negative-sum environment.
But your framing assumes that any environment where participants compete and where the majority fail is inherently illegitimate. High-level athletics, venture capital, technology entrepreneurship, all of these feature massive failure rates and a heavy concentration of success at the very top. We do not call the venture capital sector an extraction scheme just because most startups fail and cloud hosting providers charge server fees regardless of a startup's success.
I accept that comparison to a point. However, when a tech startup fails, they have often attempted to build a new product or service. There's a potential positive externality. Even in failure, they advance technology or train engineers. When a retail day trader loses their life savings trying to scalp a momentum stock on a Tuesday morning, there is no positive externality. The capital simply transfers directly from their retirement account to a high-frequency trading firm and the exchange operators.
I would argue the externality is liquidity and price discovery. Those are essential functions of a healthy capital market. Without active participants constantly expressing their views through capital allocation, markets become illiquid and inefficient. That raises the cost of capital for businesses everywhere. When companies can't raise money efficiently, economic growth stalls.
Well, we have covered a substantial amount of ground today. And, my position remains that the retail trading environment functions predominantly as an extraction mechanism. It relies heavily on survivorship bias to obscure the reality that the vast majority of participants are going to be wiped out. It depends on bad advice, homophilia, and anti-skilled influencers to drive engagement and volume, all while hardware providers and exchanges collect guaranteed infrastructure tolls from the endless churn of retail capital.
And my position remains that underneath all that noise and the undeniably high failure rates, trading is a rigorous, legitimate discipline. The empirical data clearly demonstrates that a verifiable minority captures real alpha. They use superior strategy, disciplined execution, and a really strong understanding of market mechanics. Lasting success in these markets is a matter of skill, not just random chance.
I think where we finally see eye to eye here is just how brutal the odds actually are. We both agree that the vast majority of retail participants will lose money.
Oh, absolutely. The market does not forgive willful ignorance. Separating the marketing noise from the actual mechanics of trading is absolutely mandatory for survival.
Protocols. You have to develop a strong awareness of your own cognitive biases. There is plenty more to explore in the material, particularly regarding the psychology of risk and how our own behavioral tendencies make us vulnerable to these systems, but we leave you to consider the evidence and form your own conclusion. Think back to that X-ray we started with. When you look at the financial markets, are you seeing a clean, visible structure? Or are you looking at a landscape where the fractures and the pitfalls are hidden just beneath the surface?